What's happening right now in precious metals markets is absolutely historic. Gold just smashed through $5,000 per ounce. Silver is testing $88. And the chaos driving these moves is unlike anything we've seen in modern financial history. I'm talking about a perfect storm, constitutional crisis at the Supreme Court, the president defying his own judicial appointees. Iran tensions reaching a breaking point with a potential military strike this weekend, and the US dollar collapsing more than 10% since the end of 2024. If you hold any investments, any retirement savings, or any cash whatsoever, the next 10 days could reshape your financial future. This isn't hype. This is breaking news unfolding in real time. And by the end of this video, you'll understand exactly what's happening, why it matters, and what smart money is doing right now. Let's start with what triggered Friday's explosion. The Supreme Court delivered a 6-3 ruling that struck down President Trump's sweeping tariffs. These tariffs were imposed under the International Emergency Economic Powers Act, and the court said Trump overstepped his authority. Now here's where it gets wild. 3 of Trump's own appointees voted against him. Justice Gorsuch, Justice Barrett. They joined Chief Justice Roberts and the 3 liberal justices. Trump called these justices a disgrace to our nation. That's a sitting president attacking the Supreme Court for limiting executive power. Markets initially celebrated this ruling. Traders thought we'd see trade war de-escalation. Gold dipped slightly. Stocks rallied. Everyone took a breath. But that relief lasted less than 4 hours, because Trump immediately pivoted. He announced 15% global tariffs under Section 122, a completely different legal mechanism. This wiped out the relief trade instantly, and it replaced calm with fresh chaos. That's when precious metals went vertical. Gold shot past $5,000. Silver surged for the 4th straight session. And the question everyone's asking is simple. How high can this go? Let me give you the numbers that matter. Silver jumped 145% in 2025 alone. Gold was up 65% that same year. And both metals have risen an additional 16.5% so far in 2026. Silver tested $82 this week, up nearly 6% in just 5 trading days. Now it's pulled back from its January peak of $121 per ounce. But analysts are saying this pullback is a gift, because the structural factors driving this rally haven't changed at all. Goldman Sachs just released new forecasts. They expect gold to slowly grind higher to $5,400 per ounce by the end of 2026. That's another 8% gain from current levels, and their model assumes relative stability. Imagine what happens if things get worse. Silver forecasts are even more explosive. Multiple analysts are predicting silver reaches $180 to $400 per ounce in 2026. That sounds insane until you look at the gold-silver ratio. It's near 59 right now. That's a 15-year low. Historically, silver catches up to gold during monetary crises, and we're definitely in a monetary crisis. Let's talk about why this is happening structurally. First, supply deficits. Silver has experienced 5 consecutive annual supply deficits. That means the world is consuming more silver than miners can produce. Every single year, for 5 years straight. Industrial demand is surging. Artificial intelligence infrastructure needs massive amounts of silver. Every AI data center requires silver for electrical connections and thermal management. Solar panel manufacturing consumes enormous quantities. Electric vehicle production demands more silver per car than traditional vehicles. This is industrial demand that cannot be delayed or substituted easily. Then you have central bank behavior. Central banks are diversifying away from US dollar assets. This isn't conspiracy theory. This is published data from central banks worldwide. They're buying gold at record levels. They're exploring silver reserves. And they're doing this because they see exactly what we all see. Unsustainable deficit spending, dollar weakness, and political instability. The US dollar index has fallen more than 10% since the end of 2024. That's a massive move in currency markets. When the dollar falls, dollar-denominated commodities like gold and silver rise. It's mathematical. But this time, the dollar weakness comes with serious structural problems. The Supreme Court ruling changes nothing about US government deficits. Whether Trump implements tariffs under one law or another law, the budget deficit keeps growing. The national debt keeps expanding, and that makes precious metals more attractive as hedges against fiscal irresponsibility. Now let's address the elephant in the room, Iran and the 10-day ultimatum. President Trump said on Thursday that Iran has 10 to 15 days at most to strike a deal over its nuclear program. He added that really bad things will happen if no deal is reached. Multiple sources, including CNN, report that the US military is prepared to strike Iran as early as this weekend. Trump hasn't made a final decision yet, but military assets are positioned. Intelligence briefings are happening daily. And oil markets are starting to price in serious risk. Iran sits at the heart of the Strait of Hormuz. 20% of global oil supply passes through that narrow waterway. Even limited military conflict could disrupt shipping lanes. That would cause an immediate oil supply shock. Oil prices would soar. One international relations professor told CNN that Trump could be spurred to strike Iran to divert attention away from the Supreme Court ruling. It's the classic wag the dog theory. Whether that's true or not, the timing is incredibly suspicious. This creates what market analysts call a geopolitical risk premium. Oil markets are pricing in higher risk right now. Gold and silver are pricing in higher risk. The question is whether that risk actually materializes into military action. And we might have our answer within days. Let's talk about what smart money is doing. Large institutional investors are rotating into precious metals. Exchange-traded funds that hold physical gold and silver are seeing massive inflows. Coin dealers are reporting shortages of physical silver bars and coins. Premiums over spot price are rising. That means demand for physical metal exceeds available supply. Some investors are buying mining stocks instead of physical metal. Mining companies offer leverage to metal prices. When gold rises 10%, mining stocks might rise 20 or 30%. But they also carry operational risks and market volatility. It's a different risk-reward profile. Others are buying gold and silver futures contracts. These are leveraged instruments that let you control large amounts of metal with relatively small capital. But futures trading is complex and risky. It's not suitable for everyone. You need to understand margin requirements and liquidation risks. The safest approach for most people is physical metal ownership. Buying gold and silver coins or bars, storing them securely. This gives you direct ownership without counterparty risk. No bank can freeze your physical gold. No brokerage can liquidate your physical silver. It's tangible wealth in your possession. Some investors prefer allocated storage programs. Companies like Bullion Vault or Gold Money let you buy metal that's stored in secure vaults. You own specific bars with serial numbers. This combines physical ownership with professional storage, but you pay annual storage fees. There's also the question of gold versus silver. Gold is more stable and easier to store. Silver offers more upside potential but requires more storage space. A balanced approach might be 70% gold and 30% silver, or adjust based on your risk tolerance and storage capabilities. Let's address the bearish arguments. Some analysts say precious metals are overbought. They point to sentiment indicators showing extreme bullishness. When everyone's bullish, contrarians say it's time to sell. But extreme sentiment can persist during structural bull markets, and this rally is driven by fundamentals, not just speculation. Others argue that if Trump backs down on tariffs or strikes a deal with Iran, metals will crash. That's possible for short-term moves. But the underlying drivers remain. Deficit spending continues regardless of tariff policy. Central bank gold buying continues regardless of Iran negotiations. Dollar weakness reflects deeper structural issues. Some people worry about confiscation risk. They remember 1933 when President Roosevelt ordered Americans to surrender their gold. But that happened under completely different monetary conditions. We're not on a gold standard anymore. The government has less incentive to confiscate because gold isn't backing the currency. Still, this is a personal risk assessment everyone must make. Here's what the next 2 weeks look like. Iran deadline expires within 10 to 15 days. If Trump authorizes military strikes, expect gold to spike above $5,500 immediately. Silver could test $100 within days. Oil would surge past $100 per barrel. Stock markets would likely decline sharply. If Trump reaches a diplomatic deal with Iran, we might see profit-taking in metals. Gold could pull back to $4,800. Silver might test $75. But this would likely be temporary unless other risk factors also resolve simultaneously. The Supreme Court situation adds ongoing uncertainty. Trump has shown he'll work around judicial restrictions. This constitutional tension doesn't resolve quickly. It creates persistent political risk that supports precious metals demand. Central banks aren't stopping their gold purchases based on short-term headlines. Their strategy is measured in years, not weeks. And their buying provides a price floor under gold markets. Every significant dip gets bought by central banks, adding to reserves. The supply deficit in silver isn't changing either. You can't will new silver mines into existence overnight. It takes years to develop new mining projects, permits, environmental studies, infrastructure development, financing. Meanwhile, industrial demand keeps growing from technology sectors. This supply-demand imbalance supports higher prices structurally. Let me give you the key takeaways. We're experiencing a historic moment in precious metals markets. Multiple crises are converging simultaneously. Constitutional conflict, potential military action, dollar weakness, supply deficits. This creates what analysts call a perfect storm scenario. Gold above $5,000 is no longer theoretical. It happened this week. Silver testing $90 looks increasingly likely. And analyst forecasts of $180 to $400 for silver in 2026 don't seem as crazy when you understand the fundamentals. The Iran 10-day deadline is the immediate catalyst, but the structural drivers are long-term. Even if Iran tensions resolve peacefully, the deficit spending continues. The dollar weakness continues. The silver supply deficit continues. These aren't problems that disappear with one diplomatic agreement. For anyone holding cash or traditional investments right now, consider your precious metals exposure. Even a small allocation provides portfolio insurance against the scenarios we're discussing. 5 to 10% of your portfolio in physical gold and silver could protect significant wealth if these trends accelerate. The next 10 days are critical. Military strikes could happen this weekend. The Iran deadline approaches within 2 weeks. Supreme Court tensions continue to escalate. And precious metals markets are responding to all of it simultaneously. This is not financial advice. Everyone's situation is different. But the facts are clear. Gold and silver are exploding for fundamental reasons. The chaos driving these moves is real and ongoing, and smart investors are paying very close attention right now. Stay informed, watch the headlines, understand the forces at work, and make decisions that protect your financial future in these uncertain times. Thank you for watching. The American Guy Finance, protecting your financial future.